Good morning. Thanks for joining. Welcome back to the channel. In today's video, we're going to talk about the top movers and fallers. As always, I'm going to talk about 3 stocks that I've strengthened their position. So I've added to 3 more positions this week, which I'm going to talk a bit about. And I've received 1 dividend payment, so I'm going to talk a bit about that. So yeah, like the video up, subscribe, ring that bell. And if you're new to investing, my link will be down below, freetrade.io/infinite-investors. Click, sign up, deposit £1, you'll get a free share of up to £200. Let's get straight into the top movers for this week. So the first top mover to speak about was the main top mover last week, and that of course is Imperial Brands. So as I mentioned last week, Imperial Brands was given an overweight rating by JP Morgan, which basically said that, it's at good value right now, and now should be the time when people start looking at buying Imperial Brands. And since then, obviously, it's had quite a significant rise from, being around £12.48, as you can see here, being some of the lows of like the past month, all the way up to £13.68, which is sitting at now. Now, Imperial Brands was definitely a stock I was considering selling. And it is still a stock that I'm going to sell. So long-term, Imperial Brands does not have a future within my portfolio. But whilst it's obviously on its current rise at the moment, partly due to this overweight, partly due to the conditions and the recession I think that's going on in the UK at the moment, I'm just going to ride it out for as long as it can. And if it starts to, go in the opposite direction, that's probably the time that I'll pull the trigger, sell, and put that money into another position. But for the time being, good to see Imperial Brands is still going up, and this week it's gone up another 4.06%. So for those of you new, I'm using the percentages from Simply Wall Street, as often they're a little bit more accurate than the percentages that you will see on Free Trade. Now, the next stock that's the top mover for this week is another UK stock, and that is Sentiment. So Sentiment this week has gone up 7.56%, and again, there's not been any significant news with Sentiment. I think it's due to the gold price starting to rise again. I think it's due to the fact that we're in a recession, and what you find is that consumer staples such as cigarettes and obviously hedged bets, things like gold, silver and other commodities, tend to do well. Sentiment had a bit of a fall, as you can see here, a couple of weeks back. So also you could potentially argue that, it was a little bit undervalued and there was an opportunity there, and some people felt it was a good, buy the dip opportunity. Obviously, I've held Sentiment since the very beginning for a couple of years now, and I do need to add to this position. I just need to find the time to do it. There's so much other opportunities within my portfolio at the moment that unfortunately Sentiment doesn't really get any additional funds, but when I find the opportunity and the time, I definitely will be adding to Sentiment's position. Now, the top mover for this week is a very, very interesting stock, and that, my friends, is Uber. So Uber has gone up this week 11.25%, it says on Free Trade, but on Simply Wall Street it says 8.24%. And one of the reasons why Uber has gone up this week is that they've announced that they're going to have a full electric fleet worldwide by 2040, and actually by 2030 it's going to be fully electric in the US, Canada and Europe. I think that's been one of the selling points of Tesla, not only it being one of the most innovative stocks, the ability to obviously scale in terms of all of the different sectors that it's looking into, but also its technology as well. I think there's just a number of people that invest into Tesla for things like, purely based off sustainability, purely based off it being green and actually good for the environment, as well as it being a good product. And I think Uber now going into the direction that it wants to be fully electric by 2030, so that's obviously 9 years away from where we are today, and then worldwide by 2040. It's actually scary to think about 20 years from now, because we're all going to be kind of old still, but it's obviously a good direction the company wants to go in. So that's been the main announcement that they've made. There's been a few other little wins that Uber has introduced. So one of them is obviously they've expanded their in-app ticketing to more than 10 cities. This is basically in certain cities you can actually buy transit tickets for public transport. and they obviously get a slight marginal benefit from that as well. They're also introducing like touchless pay for certain restaurants. So, obviously we are in a pandemic period and a lot of people are worried about germs spreading and being contactless and being safe. So Uber's basically launched a way that you can actually go to a restaurant and pay via your phone without actually having to have cash or, whip out your credit card, etc., etc. So they are doing other things. Have those things been material in this week's movement? It remains to be seen. All of the things I say is personal opinion. It's not necessarily fact at all whatsoever. But I think any time that a company is continuously, building the utility of its feature that, allows more people to get some value from it is obviously going to be a good thing. So I think that's all good for Uber. It's good to see Uber's gone up this week. Uber's been a stock that's obviously had quite a bit of a bad time recently. A lot of legal issues, a lot of legal battles and challenges, a lot of challenges with the whole ride sharing situation. So it's good to see that Uber is on an upward trend, and I'm hoping it will continue through into next week. Now, breather. Let's go into the top fallers for this week. Now it's going to be very interesting. The first top faller to talk about is Micro Hard. Listen, Micro Hard has had a little bit of a soft performance this week and has gone down 4.15%. I think one of the main reasons why Micro Hard has gone down 4.15% is their whole Microsoft xCloud subscription streaming gaming service. So for those of you that don't know, Microsoft has launched a subscription streaming gaming service called Microsoft xCloud, similar to Google Stadia, and it's basically, rather than having on-premise games that are via a CD on your PlayStation device or whatever, they're creating this cloud ecosystem where on any device you can kind of log in and play 1,000 games built by different developers and so forth. Now Google Stadia announced, and they launched that probably maybe about a year ago now, somewhere along those lines. Microsoft xCloud is similar vein, but the challenge with Microsoft xCloud is that they only are launching it from September the 15th, but only on Android. And one of the main reasons is through Apple's restrictions that each game needs to be a separate application. They need to have a separate developer relationship with each individual game and developer. And then it's going to be subject to Apple's 30% revenue. So Apple's got a very, very restrictive business model, which is good for Apple in terms of revenue, but it's alienating a lot of people. You guys might have seen headlines about Fortnite and Apple having some legal battles and issues. It's pretty much based on the same thing. A lot of developers are basically saying that Apple's 30% margin, and what that basically means for those of you that don't know, any application that launches on the App Store, that means a user needs to buy a service or make a payment through that application on the iOS device, and using in-app purchase as the means to do so, Apple basically takes a 30% cut of every single transaction. So some of those games that have little 99p microtransactions or £3.79 microtransactions, Apple's taking a 30% cut of everything. Now that's good if you're an Apple investor, but if you're a developer, it can hit your margins quite significantly. And so that, I think the news that Micro Hard is basically not going to be launching on Apple and they're going to be just launching on Android, I think that's not really a great message to send out. Me personally, I'm an Apple user. Obviously, I'm using an iPhone, to record this video right now. And so, I think that that's probably had a bit of an impact on the stock price this week, because Micro Hard has not really had a parabolic rise over the past months or, this year. It's had a good sustainable rise. I see it as a good, sustainable, safe growth stock to be invested into, but it's not gone in the same vein as some of the other stocks that we've basically seen this year. Your Squares, your hundreds of other stocks. I can't even think off the top of my head, but been loads of obviously stocks that have just gone up crazy this week, like loads of 100% return stocks this year. So I think it's interesting. Hopefully they find a way to resolve that situation, but I think for the time being, it launching on September the 15th only on Android is probably not really a good news story, and I think that's going to cloud Microsoft xCloud's launch, pun intended. But we'll see what happens there. Now, the next stock to talk about is the stock we just spoke about in relation to Micro Hard, and that's Pineapple. Apple, for those of you that don't know, I rebrand all of my stocks, based on how I feel. Basically, they've got an event on September the 15th as well. They've got the Apple special event. It's a yearly event that they do where they talk, they sit in that stadium in Cupertino. It's all black. They've got the big screen in the background. They talk about all of the new products and services they're going to be launching. Everyone goes, ooh, and starts clapping. And, everyone gets excited about the new products that they're going to be launching. However, the reason why it's gone down 6.18% this week for me is quite simply the fact that they are not going to be announcing their new 5G iPhone. So it was expected that they would be announcing a 5G iPhone, and considering that iPhones is the largest part of their revenue stream, I think it's had a big impact on the stock price this week, and that's the reason why the stock price has gone from highs of about 130, I think it was, till where it is now at 112. Now, if you are an Apple investor, whether you got in early or whether you got in late, Apple is still, for me, a company that I think most people should consider having in their portfolio, particularly if they've got even one Apple device within, their home. It's very interesting to have and to use services on a day-to-day basis and then not invest into those companies. Unless those companies have a really, I guess kind of controversial way that they manage their finances as a business. And there might be some examples of companies like that. But generally speaking, if they have general, normal, regular accounting practices and they have products and services that you use on a day-to-day basis, and they are growing their products and services and their revenue grows when you look at their quarterly earnings on a quarter-by-quarter basis and their margins grow on a quarter-by-quarter basis, then it remains to be seen why you may not invest in such a business. Anyway, I'm investing into Apple. Apple is going to be, one of the stocks that I will add more to next week due to this drop, and I actually hope it continues to drop a little bit. I want to get a little bit more shares, and I've been buying. I've been added to some of my positions, which I'm going to talk about a bit later on, but most certainly I'm going to be holding Apple for the long term. So yeah, Apple's good. The last stock that is the top faller for this week is Tesla. Tesla's gone down this week 10.9%, it says on free trade, but 11.24% on Simply Wall Street. On Tuesday, after Labor Day, obviously the market was closed on Monday in the US because of Labor Day. So on Tuesday it opened and it had its biggest one-day drop of around 20% on Tuesday, which is absolutely significant, and probably one of the biggest one-day drops I think Tesla's ever had in its history trading on the public market. So, for those of you that are acting like it's not a significant drop, it is a significant drop. The main reason for the drop was due to the non-inclusion of being put into the S&P 500 index. So the S&P 500, they get together every quarter and they basically decide which stocks are going to be added to the index, which stocks are going to leave the index, etc. They added Etsy, Teradyne and Catalent. Etsy, incidentally, is a stock that I hold in my Trading 212 portfolio in one of my pies, but they did not include Tesla. Now, it's very speculative when you want to try and find the reason why they didn't include it. They didn't do no formal announcement themselves. So no one from the S&P 500 committee has actually come out and said, we did not include Tesla for XYZ reasons. They're not under any obligation to basically do that. So any news and information around why Tesla was not included is going to be pure speculation. So in light of that, I'm going to speculate myself. I think one of the reasons that I think Tesla wasn't included is when you look at what contributes their main revenue streams. So when you look at the fact that their main business at the current moment is cars, whether you like to think about their battery business, whether you want to talk about their solar power business and all of the other trinkets that they do, their main business as of this current minute is cars. And when you actually look at their car sales and the revenue specifically that they've made from car sales, it's actually gone down on a quarter by quarter basis. The reason why Tesla has been profitable over the past quarters is due to the fact that they've been selling what's called regulatory credit. So effectively, there's so many different government and social bodies and agencies that are trying to protect the environment and make sure that the environment is zero emissions and obviously is clean. And if car companies are not meeting up to certain regulatory standards, they get fines, and those fines are significant fines. They're not the same type of fines that you see some of these banks getting for PPI. These fines are in the billions, so they're significant fines. Now, because Tesla is purely an electric vehicle company, they basically have an unlimited amount of credits because their whole business model is basically sustainable. However, when you look at the likes of Ford, General Motors, etc., they are typically sustainable in terms of the fact they've got diesel, petrol vehicles, etc. So what they do is basically they have to do one of three things. They either have to change their vehicles to basically become sustainable and be electric, which is not something they can do overnight. They've got to include the technology within their existing vehicles, again, not something that they can do simply or easily. Or alternatively, by the end of the year, when these regulatory bodies check, they have to basically buy these credits of Tesla. So what they've basically been doing is buying all of these regulatory credits from Tesla. It's basically like me buying points of your driving license so that you don't get a fine at the end of the year. That's literally what they've been doing, but in a corporate standard. So it's what I'm trying to say. The roads and the corporate life is all the same thing. They just basically mask it under legislation. Anyway, I digress. The point of the matter is all of these companies have basically been buying these regulatory credits from Tesla in the tune of like $1 billion this year, and that has significantly had an impact to Tesla's revenues and profits, and the reason why they've been profitable for the last 4 quarters, which is one of the requirements to become a constitute within the S&P 500. Now, because of that, if you look at it going forward, that's not really a sustainable business model. They can't continue to sell regulatory credits because sooner or later, those other businesses will catch up. I mentioned on my Instagram at some point this week that Ford, General Motors, has basically taken a big share of Nikola, which is going to be a purely electric vehicle play. So eventually, all of these car companies worldwide, and this is not just a US situation, this is a global situation, these car companies are going to catch up in terms of having, an electric vehicle fleet that meets the standards of these regulatory bodies. Now, I'm not saying that these car companies are going to be as big as Tesla or grow further than Tesla, but just primarily from the fact of, will they need to buy Tesla's regulatory credits? No, they won't. So when that situation arises, what you're going to want to see is that Tesla's other businesses are going to be able to sustain it going forward. So, they haven't been included into the S&P. I personally think that it's because one of their revenue streams is not, again, general accounting practice. It's not a revenue stream that's sustainable or that really reflects the purpose of the business. And I personally believe that that's one of the reasons why Tesla was not included in the S&P 500, and that contributed to one of the significant drops this week. I think also one of the other factors is their $5 billion capital raise. So, with all of these revenues and the free cash flow that Tesla does have, the question becomes, why do you need to raise capital? I don't actually think the capital raise was necessarily a bad thing, but naturally speaking, if a company is going to raise a $5 billion amount of capital, and it's not instantly, it's basically a revolving line of credit that they can basically dip into over a certain period of time. At the moment, because obviously rates are so low, capital is cheap. I think they've done it just because it's actually cheap to do at this current moment. We talked about another stock raising money last week. I can't even remember which stock it was over the top of my head. On the top of my head, I'm talking too fast. On the top of my head, there was a stock we spoke about last week that raised a lot of money, but they didn't really need to, but they did it. PayPal. PayPal raised a lot of money as well via capital, and we talked about their terms and their bonds and so forth. Now, I think companies do that just because they prefer to use other people's money. So I don't think that's necessarily that bad a thing of why Tesla's done that, but it does probably introduce a little bit of a short-term depreciation of their existing shares, from the simple fact that people are believing that, okay, so if they're actually raising money, maybe they're not in the financial position that we thought they were. So it's more of a perception situation at this moment. In any case, their battery day is coming soon. I believe it's September the 22nd. They're going to be announcing a lot of exciting things, and I expect that the share price will probably, off the back of that period, start to rise. So, a lot of people wanted to see Tesla shares down. They are down. I think this is a great opportunity to buy some more Tesla shares if you are long on Tesla in the long term. And so, I see this as a good opportunity. And, this is the reason why Tesla is one of the stocks that I've added to this week. So now I go into the next segment in terms of what positions I've added to. Tesla, as you can see, I added this week. In hindsight, I would have preferred to have added towards the latter half of the week. I kind of did it a little bit hastily towards the earlier half of the week, but I think I'm probably just nitpicking at this stage. And so Tesla I added to my Tesla position. The next stock I added to a position was AMD. So AMD, obviously a very profitable business for me, but it is having a significant drop from where it was in the highs of sort of 92, it being at 76 right now. I added to my position, as you can see, a small £500 introduction there. Unfortunately, that wasn't at 76. That was around the $82 mark, which is still significantly down from these highs. So I might be putting in another position in AMD, whether here or trading 212, because my ISO allowance is looking a little bit meaty right now. I don't have that much ISO allowance available. And then the third stock I added to again was Cloudflare. Again, I've got growth stocks that certain positions, certain stocks that I've mentioned to you that I want to be holding for the next 5 years. So whilst they're down now, I don't want to be sitting here in 3 years time talking to you about, I regret not adding more when it was down, I regret not adding more, because there's going to come a certain time where I'm not going to add any more money to these stocks regardless of what happens. I'll just leave it and just let that portfolio grow and be looking for other opportunities and just selling at a profit. So whilst it's down now, and whilst I still maintain that I think Cloudflare is a really exciting business that has a lot of long-term prospects, and my theory is that Cloudflare will become a profitable and a net income positive business in around 3 years from where we are today. So today's September the 12th, so I'm talking about the third quarter of 2022. Is that correct? Yeah, no, 2023, I believe that Cloudflare will become a net income positive, and I think that share price around that time could be anything of hopefully around the 250, 300 mark. Again, this is all valuations based off a few different factors that I've looked at, and so because of that, I'm just going to be adding more now. But when it gets to like $50 a share, $60 a share, I won't be adding no more money into Cloudflare at those prices. I'll just be leaving it and being happy that I'm one of the investors that got in at under or around the $40 a share mark. So that's basically it. Cloudflare, AMD and Tesla are the positions that I've basically added to this week. Now, I have received a dividend this week, and obviously dividend updates are going to be very, very few and far between, because I've got fewer and fewer and fewer dividend businesses, particularly because I sold so many of my UK stocks last week. But I received a dividend from Microhard, so that was an £8.86 dividend. As I mentioned before in the update, I don't really see Microhard as a dividend investment. I see that there's 3 types of investors, maybe 4 if you want to include contrarian, but typically you've got a dividend investor, a value investor, or a growth investor. I see myself as a hybrid. I was originally value, but I've transitioned myself more towards growth, but I'm not fully growth yet. So I would say I'm a hybrid investor, but probably 70-30 leaning towards growth versus value. And so when you do have stocks of value, they typically pay dividends, and Microhard pays a dividend. However, I just don't see them as a dividend business. I see them as a very safe growth stock. I see them as a stock with a lot of, utility going forward. If you look at their cash reserves and their constant acquisitions over recent years, if you look at their cloud infrastructure and their whole software ecosystem, the whole thing appeals to me. And that's the reason why I see Microhard as a growth stock. I see them as a safe growth stock that's going to continue to do well in the long term. So will they grow as high as the likes of Teslas, the Cloudflares, the AMDs? I don't expect them to, but I expect to be able to put money into Microsoft and know that the value of that money is going to grow way further than it being in cash, it being in bonds, it being in T-bills or CDs or whatever crap people invest in nowadays. It will be good in the long term. That's basically my philosophy on that anyway. So listen, hopefully you found this portfolio update interesting. If you did, please hit that like button, please subscribe, please ring that bell, and I will catch you next time with another investment video. Take care, guys. Peace.